In this video, Dom on our team goes deep into all the numbers of a typical life insurance policy with zero cash value in the first year, an overfunded policy. We talk about term riders. We also show you what a front load policy would look like, and he touches on other riders. This is for the people that want to, again, look into the numbers and analyze the difference. And this is just a video that walks you through our process of how we work with people. And so I hope you find this helpful. The disclaimer is everybody's a little different. We're probably going to get comments on like, what about this company and this design? And as Dom said, like we take each person and their individual situation. It's unique. And so we have to customize a policy around what you want to accomplish. But this will give you a good idea and hopefully will help answer some of your questions as you're out on a journey trying to figure out the best policy and solution for your needs.
All right, I hope you're enjoying the And Asset Vault up to this point. We're going to dive in now to some And Asset illustrations. And in my opinion, this is going to be the most fun section of the entire vault. Other people may argue against that. I definitely know Caleb would. So in regards to the And Asset illustrations, let's dive right into them. So this policy design specifically is going to show us a few different things, right? We want to be able to make sure that we can clearly articulate what is the design in the policy, what is the base, what is the PUA, any type of riders that we're going to put onto these policies, what is the cash value, death benefit. We want to make this a one-stop shop for being able to understand what an illustration looks like, what the numbers look like, and what a well-optimized design and asset looks like. And so with that being said, I have an illustration in front of me. And this illustration specifically has two sides. It has a guaranteed and a non-guaranteed side. So the guaranteed side of the contract is essentially what you're going to get no matter what happens. You are contractually binded to getting these dollar amounts within the cash value here, then the death benefit. So total cash value here, total death benefit here. You were guaranteed to get that no matter what. So individuals like whole life insurance because they have those guarantees built into them no matter what happens. Now, the other side is the non-guaranteed side, which is essentially saying the guaranteed plus a dividend. You being a policy owner, right? You now are an owner of the company and only if it is a mutual life insurance company. It's very important that when we get these policies set up, that we use a mutual company and not a stock company. As a mutual company, you are an owner if you have a life insurance policy. And by doing so, you get a dividend every single year on top of that. So this non-guaranteed side is the guaranteed plus the dividend. And the non-guaranteed side, the dividend has essentially been paid out for over the last 100 years. These companies have not missed a dividend payment. Now, the dividend will increase or decrease based off of interest rates and based off of profitability of the companies. But what we're going to do is we're going to look at the non-guaranteed side. Since companies have not missed a dividend payment over the last 100 years, we're going to focus on the non-guaranteed column. So what we're doing here is this is our total premium amount, our contribution. So you can see with this policy specifically, we have $100,000 going into the policy. Within the first year, we have $78,265 that is available for loan amount if you choose to, for whatever that purpose is. You'll see that the total death benefit you have as well is $2,790,360. If we come over to this far left side, it gives us essentially the breakdown of what the policy design looks like and what is happening. So what we have here is we have the base contract. Okay, so what I want you to consider when it comes to the base is essentially, think of it as the cost of insurance. This is what's going directly to pay for the insurance, which is the death benefit. And then we have the paid up additions, which is here, which is $72,657. And this is essentially the rider that we put on to quote unquote overfund the policy. Majority of this cash is going directly into the policy's cash value. Then what we have here is a term rider. What the term rider does is it essentially increases the death benefit at a very, very cheap cost. You see what would end up happening if we increase the death benefit with the base. So if we increase the base to, let's just say, $50,000 was going into the base contract, our death benefit would be a lot higher. But because we're doing a term rider, what we're doing is essentially increasing the death benefit so we can shove more cash into it without the policy necking. And what we don't want the policy to do is MEC, which is a modified endowment contract, which is just essentially saying that we no longer get the tax benefits that come with life insurance. So here's the policy design specifically, right? We have our PUA, we have our term, and we have our base. You can see the percentage of the overall amount of the $100,000 premium that's going to the base. In this instance, it's about 14%. You'll be able to see that once we get down to age 15, right, year 15, we'll be able to stop all PUA, no more PUA going in the policy, and we can just continue to pay the base. These policies can be designed and structured essentially however we choose to do so. We can pay the PUA longer, we can pay the term longer, we can do it shorter, we can only do it for 10 years. There's a lot of different ways that we can design the policy, and it's all going to be based around your goals and what you're trying to accomplish. Now, something that I want to point out is what a non-overfunded and asset essentially looks like. And I wouldn't even call it an and asset. What I would call this is typical whole life planning and what a typical whole life policy looks like. When you hear a lot of people talk negative about whole life, my opinion, when you see a policy design like this, it is extremely terribly designed, negative place to store capital. With that being said, I'm going to show you that as well so you can see the difference between the two. So if we come over here, you'll be able to see it's the same exact amount of premium that's going into the policy. This is the base, $100,000. All of that premium is going directly to the cost of insurance. You can see the total cash value, if we come over to the non-guaranteed side, is $0 and $0 for the first 2 years. So if you believe you're your greatest asset and you're an entrepreneur or a real estate investor and you're putting $200,000 into a policy, you have $0 within your first 2 years. You can see why this is not a very well designed policy. That is not a great place to store capital and to store your dollars. You can see the death benefit is also almost $6 million versus if we come over here, the death benefit is only $2,790,000. So you can very easily tell the difference between a well-structured, designed, overfunded whole life policy and a terribly designed whole life insurance, what's the typical industry standard that you see from 99% of individuals that design them. And the truth of the matter is a policy like this, the agent, whoever's in charge of the contract, will also get 5 times, if not more, the amount of commission than they would for a policy that is designed like this, which is why a lot of agents specifically don't design contracts like this, because it's really hard to, can make a living and to continuously keep the business in place because, you don't get paid a ton in conversely with the other contract getting $100,000 essentially is what they would make based off of the goose egg, I call it up here goose egg, goose egg policy of 0-0 the first few years. So I just wanted to show that if you ever come across a design and you can, get the question often is this a overfunded? Is this an and asset? You'd be able to tell based off of the early cash value, how high is the death benefit and what is your available use within the first couple of years. So with something I also wanted to show you so you have an idea of another rider that sometimes gets put onto the and asset is something called a premium of waiver rider. And that's essentially saying if I get disabled, the life insurance company is going to pay my premiums for me. Now, every company is going to be different. And so it's just very important to get into the nitty gritty and find out if this is a good rider for you and based off of the rider for company specific. Some companies will pay your PUA for you and your base, and some companies will only pay your base. And then there's everything in between. So I'm just going to show you the difference in cash value. If you were going to do something like that, just put that waiver on there. So this has without the waiver, there's $78,265 total cash value. If I come over to here and I put the waiver on you'll see that I only have $77,313. So you're essentially paying about $900 that year for that waiver. But if you do get disabled and something happens, the life insurance company will continuously keep paying those premiums for you. So now what I want to do is I want to go ahead and dive into a separate policy. Scroll it over here for you. And what this will look like is it'll give us the ability to see what a dump-in will look like if we if we do a first year front load into a policy. And so the last contract that I showed you did not have a first year dump in, did not have that front load. But by doing a front load, it allows us to have even more cash earlier on and being able to expedite the quick growth of the policy. So if I go ahead and zoom in one more time for you, you'll see that this policy has a $50,000 contractual premium, and then it has a $20,000 annual contribution therefore after. And you'll see that within that first year, we have $42,779,000 that we can use for whatever that purpose is. If it's for real estate, our business, emergency fund, whatever it looks like, whatever it is to you specifically, we have this $42,779 to be able to loan against to use for that purpose. Our death benefit in this instance is $1,221,000. And every single year after, we do a $20,000 contribution. You saw in the last design that I showed you that the base was about 14% of the overall premium. To be transparent here, this base is a 70-30 design, so 30% of it is going towards the base and 70% is going to the PUA. Now, when it comes to an overfunded, well-designed policy, anywhere from 70-30 to 80-20 to 90-10 will essentially be a well-designed policy. There's going to be variances on does it make sense to go that high from a PUA to base or going to a 70-30. What I will say is it all depends. I've seen contracts where they perform better earlier for a 90-10, but they don't perform as well later on at the 90-10. And then I've seen them where a 90-10 performs great from the beginning and later on. A lot of the times when you put on paying PUA for even longer, that's typically when you see that the 90-10 will not outperform essentially a 70-30 long term. So it's all going to be based around how long you're going to be contributing. What is the goal? Do we want early high cash value, even though we may neglect the performance in the tail end of things? And so that's why it's just really important for us to get really clear on what it is you're trying to accomplish, where it is you're going, so we can design a policy specifically for you. Once you start getting below that 70-30 mark, and you start getting, to 60-40, 50-50, like I would say you're no longer getting into the overfunded piece of the policy, and you're kind of just like halfway in between the goose egg and a well-designed optimal policy. So with that being said, there's something else that I wanted to share and show with you is that this policy specifically is a super preferred health rating. So health ratings are super important when it comes to an asset. If we don't go through underwriting and we don't get a health rating, then we're not able to even qualify for an and asset. But if we can qualify for it, the efficiency of the policy will vary based off of our health rating. So what I wanted to show you specifically with this design is this is a super preferred and asset, and it has a total of $42,000 of cash value here to be able to use. But if I come over to this column, which is a standard policy, you see that it has 42,157. So it's not a drastic difference. But if I scroll down and we look at age 65, we'll be able to see that over a period of time, it makes a little bit more difference. So there's $562,000 here, and then we come over to the super preferred, and then we come down to age 65, and we'll see that there's $600,000. So because of the health rating, it gives, close to a $40,000 difference in overall cash value, which is why getting a health rating is super important. And now when it comes to the flexibility of these policies, I think it's super important to be able to articulate to you why I think Overfund Whole Life is a great place to store capital for the real estate investor, for the entrepreneur, for somebody who wants to have that flexibility. Because we have a maximum and we have a minimum within the policy and within the contract. So if I come over to this one, it'll make it easier to see. This policy specifically, the maximum amount that we can contribute into this policy is $20,000. Okay, so that's our maximum. That's our ceiling that we can do. If we put in any more than that, we can't, because if we do, then it becomes a modified endowment contract, or we start to lose our tax benefits. The minimum amount that we have to contribute is essentially the base of the policy. Right. A lot of times it's the base plus the term rider that you have to pay to keep that in place as well. So I'd say close to about $6,000. You can see here that we have of the base contract is the floor of what you have to pay on an annual basis, no matter what happens, to keep this policy in force. Now, there are some creative ways to do so if even the $6,000 became an issue, where we could take a policy loan to pay for that base premium as well, because we would have cash value available as the later years go on. So if you somehow lose your job, your cash flow didn't come in the way you thought, investments didn't work out, whatever was going on from a cash flow perspective, you have that flexibility. Obviously, we want to overfund this policy for as long as possible, and not be able to miss any payments, because we won't have optimal efficiency. Something else to consider is something called a catch-up period. So if I say I'm in year 6 and I pay $20,000, and then the 7th year I come into a bind and I can't pay that full $20,000 and I can only pay the 6, you can pay that $6,000, and then the following year after that, you can do what's called catching up, which means you can pay your full premium in the next year of that $20,000 plus all the premiums that you missed from the previous year. So in this case, it would be $14,000. So your total payment for that year would be a $34,000 contribution. So I hope this helps. We talked about a lot. We talked about what a well-designed policy looked like, what the term riders were, what the bases are, what the PUAs are. We talked about what the premium of waiver rider is. We talked about the flexibility of the policies. We looked at a couple different ones, talked about the benefits of a dump-in. One other thing that comes up is an accelerated death benefit rider, which is just essentially saying that you can tap into your death benefit if you get sick. It's a chronic or illness sickness. You're able to use a piece of your death benefit to take care of your healthcare coverages. So you're able to use it as you're alive, just as you're able to use for your cash value as well. And so that's just another rider to consider. So I hope this helps. Like I said, I think this is actually the most valuable piece of the entire vault. I absolutely love this time, was able to share and demonstrate these designs with you guys. If you have any questions, as always, you can reach out to us. I'd be more than happy to sit down with you. If you book your meeting, we can have the potential to sit down with a specialist, sit down with myself, and be able to specifically design a policy that is tailored for you. Hope you have an amazing day, and looking forward to meeting all of you.
Hey, I want to thank you so much for watching this video to the end. This video is on life insurance, and if you have more questions about life insurance, infinite banking, why you should overfund it, we have a link below that goes to our And Asset Vault. This is a free vault that gives you everything you need to know about life insurance. We have case studies, we have a calculator on there, we have a handbook, we have frequently asked questions, we go through a process. I have my masterclass on there. We literally want to be the one-stop shop for every life insurance decision. And so if you want to learn more, click the link below, and we look forward to educating and maybe opening your mind and eyes to the power of life insurance.